Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know. First, Fed official warns of stagflationary dust after rate cut, challenging market hopes for aggressive easing. So we'll discuss why this internal dissent complicates the Fed's path forward and what it means for the future of interest rate cuts and market expectations. Second, Fed Chair Powell calls equities highly valued after rate cut, attempting to jawbone a red-hot market. We'll explore how this verbal intervention aims to cool speculative behaviour and what it signals about the Fed's new threshold for supporting financial markets. Third, Miami's 40% rent boom hits zero as national growth stalls, a key leading indicator for inflation. We'll analyse why this rental market data is a crucial signal for future inflation readings and how it could influence the Federal Reserve's rate cut timeline. The Federal Reserve just cut interest rates, but don't pop the champagne just yet. In a surprising move just days after the decision, a key voting member is already pumping the brakes. A while back, we said that first cut looked less like a victory lap and more like a panic move to head off a labour market crack, especially after that shocking June job loss. Today's tone from inside the Fed suggests a quick pivot back toward inflation vigilance. Chicago Fed President Austan Goolsbee went on the record with a direct warning to markets, saying, I think we need to be a little careful with getting all really upfront aggressive. Why the sudden caution? Goolsbee dropped a staggering fact. Inflation has been over the Fed's target for 4.5 years in a row, and it's rising. He's warning the economy is trying to shake off what he calls stagflationary dust, signalling the fight is far from over. We previously analysed how the stickiness is concentrated in services. The new twist is Goolsbee's framing that this dust is still in the air even after a cut. So the thing is, stagflation is an economist's nightmare. It's when economic growth stagnates while inflation remains stubbornly high. The dust Goolsbee is referring to is the persistent inflation in the services sector, things like haircuts, car repairs, and restaurant meals. And while goods inflation has cooled, what's really causing headaches is this supercore services inflation, which is much stickier and harder to control. The latest data shows that while overall inflation has eased slightly, the cost of services continues to climb. This is the core reason for his caution. If this dust proves hard to clear, the dream of a soft landing could be in jeopardy. And the plot thickens. That rate cut last week wasn't unanimous. The Federal Open Market Committee voted 11-1, revealing a crack in the consensus. As we noted a while back, the lone dissenter pushed for a larger half-point cut, a clear tell from the camp most worried about a jobs downturn. Now, a non-unanimous vote inside the Fed isn't just a statistic, it's a signal. Dissents often act as a leading indicator, revealing deep fractures within the committee about the correct path forward. The identity and reasoning of the lone dissenter can tell us a lot about the Fed's primary fear. Are they more worried about stubborn inflation or a looming recession? This single vote against the cut suggests a powerful internal debate is raging. Against that backdrop, Goolsbee's caution today strengthens the inflation-first side of the argument we've been tracking. This is the core conflict playing out inside the Fed. While the committee's own projections suggest the neutral rate could be around 3.1%, implying more cuts could be on the table, Goolsbee's public warning creates a massive cloud of uncertainty. Remember, we previously flagged how scattered the dot plot has become. Uncertainty around where that neutral rate or R star really sits is a big reason those dots are all over the map. Let's talk about this neutral rate, or R star as economists call it. Think of it as the Goldilocks interest rate, neither stimulating growth nor slowing it down. You know, no one actually knows what this magic number is. It has to be estimated. The Fed's 3.1% projection is just that, a projection. If the true neutral rate is actually higher, it means current interest rates aren't as restrictive as they seem, giving the Fed less reason to cut aggressively. This uncertainty is a major source of market anxiety. He's not just talking, he's acting. The Chicago Fed just rolled out its own proprietary labour market monitor, a new tool using 11 different data sets to get a real-time read on the economy. A few days ago, we walked through the payroll revisions, and that June job loss, this new monitor, looks designed to test those recession signals in real time. And the kicker with this new tool, it's called the Chicago Fed Unemployment Rate Nowcast, or churn. And it doesn't just rely on traditional government surveys. It pulls in real-time data from sources like payroll company ADP and even Google search trends. So while some traditional data suggests the job market is softening, this new tool is showing underlying stability. This could mean the labour market is more resilient than we think, which would reduce the Fed's urgency to cut rates and challenge the market's hope for a rapid easing cycle. If that resilience holds, it would also counter the tipping point narrative we highlighted earlier. So what should we watch for next? The key will be the tug of war between that supercore services inflation and the employment numbers. If services inflation stays high and the labour market remains resilient, Goolsbee's cautious view will likely win out, meaning fewer and slower rate cuts. For listeners following our SARM rule discussion, keep an eye on whether that 3-month unemployment average inches closer to the trigger, especially if it diverges from Churn's read. This could lead to higher bond yields and put pressure on stock market valuations. For our audience in the Greater China region, a more cautious Fed often means a stronger US dollar, which could impact the yuan's exchange rate and capital flows. The takeaway is clear. While the first rate cut is on the books, a powerful voice inside the central bank is making it known that the war against stubborn inflation is the top priority, turning every future rate decision into a high-stakes tightrope walk. Speaking of the Fed's delicate balancing act, Chairman Jerome Powell just took a more direct approach to managing market expectations using 2 words that sent a chill down Wall Street: highly valued. Just days after the Fed cut its key interest rate, a move that helped propel markets to record highs, Powell stated directly, quote, "By many measures, equity prices are fairly highly valued. We previously analysed how markets had largely priced in that cut." The new development is Powell pairing it with a pointed valuation warning. This, actually, is a classic central bank tactic known as jawboning. It's a form of verbal intervention, using words to cool down market enthusiasm without having to change interest rate policy. It's a powerful, low-cost tool to tap the brakes on speculative behaviour. A while back, we noted that traditional rate moves are losing some punch, so expect the Fed to lean even more on words when the usual channels don't fully transmit. This is the head of the world's most powerful central bank essentially questioning the very market rally his own policies helped create. Powell acknowledged that markets listen to the Fed, but his comments suggest he thinks they may have gone too far, too fast. This is Powell trying to thread that needle in real time, acknowledging labour market softening while keeping an eye on inflation. The risk here is a potential feedback loop that worries the Fed. When the stock market rallies hard, it actually loosens overall financial conditions, making it cheaper for companies and consumers to borrow and spend. If conditions get too loose, it can work directly against the Fed's intentions, possibly reigniting inflation. So, ironically, a market that celebrates a rate cut too enthusiastically could force the Fed to become more cautious or even delay future cuts. A few days ago, we mentioned how softer labour data was capped by a jump in jobless claims. Combine that with alternative credit channels, and you can see why the Fed is wary of markets loosening things on their own. But here's where the situation takes a more complex turn. In the same breath, Powell insisted this is, quote, not a time of elevated financial stability risks. He's saying prices are high, but the system isn't about to break. It's a verbal tightrope act, and investors are paying close attention. This might sound contradictory, but the Fed is drawing a very important line in the sand. They are explicitly separating highly valued assets from financial stability risks. Believe it or not, high stock prices alone don't scare the Fed. What they are really watching for are signs of excessive leverage, like high levels of debt in the banking system. So Powell is signaling that the threshold for intervention has shifted. The new Fed put, the idea that the Fed will step in to save markets, is now triggered less by a drop in stock prices and more by a genuine threat of a credit crisis. This means the game has changed for investors. Unless leverage becomes the problem, the Fed is unlikely to ride to the rescue just because prices are rich. The immediate reaction was swift. Stocks, which had been climbing, dipped into the red following his remarks. It was a clear demonstration of how a few carefully chosen words can override a major policy decision. This is exactly the caution we said to expect. And this really puts the Fed in a unique position globally. While Powell is trying to talk down a hot market, central banks in other major economies, like the European Central Bank and the People's Bank of China, are easing policy because their economies are showing weakness. This divergence tends to make the US dollar stronger as capital flows into the relatively healthier US market. For a Chinese-speaking audience, this is particularly important. A stronger dollar puts pressure on China's exports and can complicate the PBOC's own monetary policy decisions. And as we've noted before, The Fed is also guarding its credibility, another pillar supporting the dollar. The market is now grappling with a central bank that is cutting rates with one hand while waving a caution flag with the other, leaving investors to decipher the real message. So, what should we watch for going forward? First, pay less attention to just P divided by E ratios and more to indicators of leverage and credit risk. These are the new tripwires for the Fed. Second, it all comes down to the wealth effect. When stock portfolios are bulging, people feel richer and spend more. This could be inflationary, creating a paradox where a strong market could actually force the Fed to keep rates higher for longer than anyone expects. And tying back to our earlier points, keep watching the jobs reports for further softness. If that worsens, the Fed could move more aggressively on rates even as it steps up jawboning to prevent financial conditions from loosening too much. We were just talking about the Fed trying to cool down a hot stock market, but in the real economy, some sectors are already hitting an ice bath. That brings us to our next story, which starts with a statistic that might just change your perspective on the inflation picture. Miami, the city that saw single-family rents soar 40% in 2022, just hit a complete wall. Annual rent growth there has plummeted to zero. And it's not just Miami. This is a sign of a massive shift hitting the entire country. After a strong start to the year, national single-family rent growth has decelerated to just 2.3%, now falling below the pre-pandemic average. This isn't just a story for renters, it has huge implications for everyone. The reason this is so crucial is that this market rent data is a leading indicator for official inflation statistics. Here's where it gets interesting. The shelter component of the Consumer Price Index, or CPI, is notoriously slow to catch up. The government collects rent data from the same properties only once every 6 months, meaning the official inflation numbers we see today are reflecting rent changes from months ago. So this current slowdown suggests that official shelter inflation could finally start to fall more quickly in the coming quarters, potentially giving the Fed the green light to cut rates sooner than expected. According to an economist at CoreLogic, single-family rent growth is clearly losing steam. July's month-over-month growth was far below its historical average, signaling a significant market cooldown. But that's not the whole picture. As pandemic-era boomtowns like Miami go flat, a new leader is emerging. Chicago is now number one among major metro areas, with rent growth hitting 5.1%, bucking the national trend. Even Los Angeles, once buoyed by post-wildfire demand, is now cooling off. This development is fascinating because it directly challenges the entire Sunbelt boom narrative that has dominated the post-pandemic era. We may be witnessing a reversal of migration and capital flows. While Miami's market remains competitive, its rapid price growth has pushed affordability to its limits. By comparison, Chicago's resilience is being driven by its relative affordability and solid job growth. This has real implications for regional economies and property valuations in both the Midwest and the Sunbelt. This weakness isn't isolated either. The slowdown is hitting everything from high-end luxury homes down to the most affordable rentals, which saw their growth rate cut by nearly half. The entire market is feeling the pressure as landlords may finally have to bend to struggling consumer finances. And the slowdown in the most affordable rentals is especially telling. Think about it. Rent is usually the last bill people skip. So when even the lowest price rental segment sees growth stall, it's a far more sensitive alarm bell for consumer stress than something like retail sales. It suggests households are stretched so thin that a broader pullback in spending is imminent. In fact, this is supported by other data, like rising credit card delinquency rates. This matters globally because if the American consumer pulls back, it reduces demand for imported goods, which could impact manufacturing in export-oriented economies like China. This all leads to a high-stakes standoff. Major rental REITs like Invitation Homes and American Homes for Rent have been aggressively building entire new communities of single-family rentals, betting on continued high demand. What really brought this to a head was the market showing clear signs of weakening, putting them on a potential collision course with a new economic reality. What's at play here is the build-to-rent strategy these companies are betting on. They are not just buying existing houses, they are developing entire new neighborhoods from scratch, a highly capital-intensive bet that relies on strong, continuous rent growth. The current slowdown is the first major test of this strategy. We need to watch the upcoming earnings reports from these large REITs very closely. If they announce a pullback in construction, it would not only signal a bearish turn in institutional sentiment, but also directly impact the supply of new housing, potentially complicating the affordability picture even further.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.